It is Wealth Wednesday, so great to have investment specialist Yvonne Delry back on the show from FirstOntario Credit Union. So we are going to talk tax-free savings account. This is a hot topic that we're hearing a lot about this year, and a lot of people don't use them properly, or don't even know what they are.
Yes.
So you want to start there?
Yes. So yeah, it's a hot topic come like January, just because the new contribution limits are announced and people want to kind of jump in and get their contributions in. So tax-free savings accounts is an investment strategy that you can use to save for any purpose. Sometimes you want to use it as a complementary to RSPs, saving for education, but you can use it for any purpose. So midterm savings goals, saving for the down payment of a home, maybe a significant vacation, or use it for long-term savings goals. You can hold any type of an investment product, so GICs, mutual funds, anything like that. The biggest advantage is that the growth that is earned within your tax-free savings account, you don't need to report on your income tax ever. So while the money is in the tax-free savings, and even when it is removed. However, when you put the money in, it's not deducted from your taxable income, so you don't get that tax break when you put it in, but then on the flip side, that doesn't happen. So when you remove it, it does not affect your taxable income.
What kind of growth would you see at a TFSA?
It depends on what you invest it in. So you should speak to your investment advisor, figure out what is the purpose of why you're saving the money and what is the best then investment strategy for that. However, the tax savings can really add up if you are tax sheltering products that have the least tax efficiency or the products that have the most growth. So sometimes tax-free savings accounts are misunderstood and they're not used properly. So that's where you should talk to your investment advisor.
How are they used improperly?
Because people are not tax sheltering the investments that are least tax efficient or that have the most growth. The other thing that I really want to stress is the amount that you can contribute, so contribution limits, and if you over contribute. So contribution limits you can start using them, Canadian residents can start using them when they're age of majority, so 18. So as soon as you turn 18, you can start contributing. Contribution limits move forward year over year. So this year's contribution limit is $6,500. If you have not contributed from 2009 and you were 18 all the way up to 2023, it's $88,000. The other thing is if you over contribute, there's a 1% penalty per month for the excess contribution. So that can really add up when you get that bill. So you should really make sure that you're keeping track of your...
Is it up to you to keep track?
You can go on the CRA website onto your personal account and you can look it up, but I still suggest that you keep track of it yourself because that total can be lacking at the beginning of the year. So institutions will report to Revenue Canada what people have contributed, but they have a time frame in the beginning of the year to be giving those totals. And then by the time they get registered on to your account, there can be a little bit of a lag time.
And you do suggest, I guess you could go to anywhere and get a TFSA, but you suggest to work with somebody just to help you out with those investments.
Absolutely.
Okay.
Absolutely. Make sure that you're using them specifically for what they are designed for.
Great having you on the show. Always
Okay.
learn something.
Okay.
So how about we do this? So next month, let's meld the worlds of TFSAs and RSPs.
Yes.
And compare the two.
And we're going to know when to use an RSP, when to use a tax-free savings accounts, because there's specific advantages to both. Dream, plan, achieve.
Coming up on our next episode of Wealth Wednesday in February. Great to have you on. Yvonne Delry, investment specialist with FirstOntario Credit Union.